Well, thank you very much. It's really wonderful to be here. And James, I appreciate the invitation to join you. And I really want to start by complimenting all of you for kind of the time, the effort, the energy to be engaged. It's really a testament, the Vail Symposium, of kind of intellectual curiosity and engagement. And I think that's something that I'm going to come back to and talk a little bit about during the global financial crisis, that some of that was lacking and actually contributed to the situation. Now, one of the things that's kind of interesting is I went to Washington in 2006, and a couple of years later, we had a global financial crisis. And then I come to Vail, and we have the biggest meltdown in the capital markets in over 5 years. And I went to the London School of Economics, and I took statistics. And I remember the professor saying that correlation doesn't mean causation, but I'm starting to get a little bit of a complex. Every time I get invited someplace, things start to go south. As James said, I'm from Boston, and I don't know how many of you may have been to Boston, but back in Boston, we have an old ballpark where the Red Sox play, Fenway Park, and we had an old garden where the Celtics played. And I look through this, and it's a nice open-air space, but at Fenway Park and at the old garden, there were steel stanchions going up every place. So when someone said, "Oh, we went to the game last night," I'd say, "Well, what did you see?" Because sometimes what you saw depended on where you sat. And David and I both have a lot of experience in both the public sector and the private sector, and I think a lot of the value that hopefully will come out of our conversation and discussion tonight reflects the fact that we have these different perspectives. And I think to understand and appreciate some of the complexity that goes on, it helps to have different perspectives. I think we know this as parents, we know this as workers, we know this as decision makers, but it was certainly true in terms of policy advising to the Secretary and the President. So tonight, what I'd like to do is to talk about the economy, talk about capital markets, talk about politics, decision making, and I also want to talk about leadership and character. Because I think all of this is part and parcel of kind of the experience that we had when we were in Washington. I should also note, while we had these different perspectives and experiences, we're here tonight as citizens to share our own views. We're not talking obviously about our companies and the work that we do or representing that, nor are we any longer speaking on behalf of the government as senior Treasury officials. So let's get started, and I want to talk about one of the things we often would focus on, what are we trying to do? What are our goals? What are our objectives as policymaking or as business leaders? And I want to start with the economy. That's the big thing. And even with today's news, this is really what we're focused on. The focus is the impact on the economy. And when we look around the world, there's lots of different types of economies. We have a democratic republic. We have a market-based economy. And I think we all have to appreciate and recognize how fortunate we are to be part of the U.S. economy. It's the biggest, it's the most diverse, it's the most powerful economy in the world. And a lot of what politicians and policymakers focus on really come down to two things. One is national security and national defense and homeland defense, but the other is economic security. And as citizens, this is really what we're focusing on. We want to make sure that we have an economy that continues to grow. Not too fast, because then we get inflation, the implications associated with that and pain, but not too slow where we get unemployment. So this Goldilocks economic growth and sustainable growth creates economic opportunity. And it's not static. And that economic opportunity, if it also has security, gives us the opportunity to have economic mobility. And the dynamism of the U.S. economy is second to none. And when we compare and contrast the U.S. economy with other economies around the world, and we're going to talk about that, I'm sure, a little bit later, what does that mean in terms of how we interact? Because our comments tonight will focus largely on the U.S. government, the U.S. federal system, our U.S. economy and capital markets. But the fact of the matter is this happens locally. Think about what the local economy has gone through here in the Vail Valley over the last 10 years. Think about what's going on around the world. And nothing is more mobile than capital. So when we think about the economy, we have to understand kind of what we're trying to do, what we're trying to accomplish, and what are some of the drivers. And we want economic growth. Well, if you want economic growth, then you have to have fuel. And so what's the fuel for the economic growth? It really comes down to the capital markets. And we always describe the capital markets as the lifeblood of the economy because in some ways you can see the signs, the signals, assess the health. But economies need capital. They need credit. They need to be able to grow and deploy capital, attract capital, incentivize the utilization of capital and lending so that people can build and create new opportunities to create economic prosperity. And the capital markets in our country are second to none. And there are a lot of attributes associated with that. But when you look at other economies that they're looking to try to grow, a good place to look in terms of how effective they'll be is to come back and look at their capital markets. What's the nature of the market? How much diversity is in the market? How much innovation is in the market? What are some of the drivers that hit that platform? But really where I want to focus my comments on tonight is this intersection. This intersection is really where it all happens. And we can think about that as professional investors, and I work with many of the largest, most sophisticated investors in the world in capital markets around the world. And certainly this was very much a part and policy of our program when we were at the Treasury Department, focused on economic policy. So as we think about this, I want to look through these two lenses, these two major sectors, the public sector and the private sector. As we think about the public sector as it relates to the economy, the public sector has a huge interest in this. We've heard prior presidents say it's all about the economy. Well, the federal government's very focused on this, and they are big players in the economy. They're big spenders. Think about the budget for the United States. Most of it is tied into healthcare, retirement benefits, defense, and then a host of other things in terms of medical research and things like this. So they're big players, and they need to continue to invest. And how do they get the money to do that? Well, then they have tax policy. So you have their spending policy, you have their tax policy, that's fiscal policy. A huge tool for governments to drive that. But that's just one. And then we have other tools. Obviously, monetary policy. We always think about the role of the Fed. If we're trying to create this Goldilocks economic scenario, well, when the economy's soft, they can lower rates and stimulate activity by lowering the cost of capital. Alternatively, if it's too hot, we see them raise rates and try to put brakes on the economy to prevent it from overheating. So you have monetary policy, you have fiscal policy. And then there's something in the news the last day or two, it's called trade policy. Okay? Huge implication in terms of the economy. But before we were talking about trade issues over the last 48 hours, one of the biggest issues that we've been focused on over the last few months has been regulatory policy. And it goes on from there. You have immigration policy. You have education policy. You have healthcare policy. All of these policies are huge players by the government. Again, whether it's at the federal level or at the state level or at the local level, are impacting the local economy. So that's one lens into the economic picture. But what about the private sector? Well, the private sector in a market-based economy plays an unbelievably important role. And here we are making choices. How do we feel as consumers? Where do we want to spend our money? What services do we require? What skills do we think our children need to be able to compete and be effective and have opportunity and economic prosperity and economic security in terms of jobs in the future? So the private sector plays a huge role in terms of the economy. But then let's go to the capital market side. The federal government plays a huge role there. Of course, they're a huge player. This is the U.S. Treasury marketplace. The U.S. Treasury marketplace basically sets the risk-free rate of credit around the world. Everything is, in a sense, priced off of the risk-free rate. And we'll talk about that maybe in debt ceilings and some of the stresses that we see in the Treasury markets periodically. But they also play a very important role, the federal government, with respect to regulation. And so as investors, what do we think about when we buy a security or an instrument? We want to know it's safe and secure. Well, this is the role of the Securities and Exchange Commission to ensure investor protection, What about our banks? That's the role of, whether it's a bank holding company, it's the Federal Reserve. If it's a national charter bank, it might be the Office of the Comptroller of Currency. A thrift with the Office of Thrift Supervision. What about insurance with the banks, with the FDIC, or the commodity markets with the Commodities Futures Trading Commission? The regulatory framework in the United States with regard to financial markets is unbelievably fragmented. And I'll talk a little bit in just a few moments that this also contributed to some of the reasons why we had the global financial crisis. So the federal government has a huge role to play with regard to the capital markets. But then all do we. We have investments every day. We make them as individuals in our 401k plans, in our taxable savings. We think about the investments in terms of the providers of capital, in terms of institutions, pension funds, foundations, endowments. And as I noted earlier, it's a global capital market, so there's investors in our country and our capital markets from all around the world. And with that is the opportunity to understand and deploy capital, but also to use capital. And so we use capital in terms of student loans, mortgages, and we'll talk about that, I'm sure, but car loans. Businesses use loans to finance payroll. Businesses use loans to finance acquisitions, or they can use capital to reinvest with a high expected return so that they can create economic growth and earnings. So in this section of the intersection between the economy and capital markets, if we think about the roles of the different institutions, we are better positioned to think about how to assess situations, how to make policies, how to make decisions, whether those are investment decisions, credit decisions, or policy decisions, or regulatory decisions. Now, when David and I were in Washington, this two-dimensional framework was pretty helpful. And oftentimes when we were in Washington, we'd meet with a lot of politicians, a lot of market strategists, a lot of economists, and they'd come into our office and tell us what they thought, and tell us what they thought we should do. And they would often do it with a great deal of conviction, and we'd listen, we'd smile, and then we'd let them go. And I'd sometimes walk by David's office and just shake my head. They're sometimes right, they're sometimes wrong, but they're never in doubt. And the fact of the matter is, it's harder than that. It's more complex. And so I want to take this two-dimensional framework and add three other lenses to help us triangulate on kind of really, as we look at these situations, how do we assess them? How do we understand them? How do we interpret them? So the first is about institutions. As you can see, there are so many players on the field. And you have to understand and appreciate you have so many different players with so many different incentives, with so many different objectives. And what happens when those objectives don't align? How do you assess that? How do you reconcile that? What conflicts can come up as a result of that? And a big part of this, too, is time horizons. What are their goals and objectives? Well, there could be near-term, long-term. And how do you evaluate the implications of some of these changes given the number of players? And it's truly global, almost everything. The second dimension is relate to relationships and risk. There's a lot more uncertainty. And when you look at what's going on in the capital markets today, and you look at some of the signals that the capital markets are telling us about the economy, we've seen volatility go up substantially. There's just more uncertainty. Well, one of the interesting things about the capital markets is they price risk. They price risk. They assess things, they figure out what it's worth, and they put a price on it. And if the market can meet there, that's where they're defining it or quantifying the risks. But we also know risks change. Risks change over time. And people's perception of risks can be wildly different. And we'll talk a little bit about this as some of the undercurrent in terms of what happened during the global financial crisis. When we went to Washington, we did our best, but we also learned a lot. We asked a lot of questions, we dealt with a lot of situations, and after leaving Washington, we got asked a lot of questions. And one of the things that I took away, in fact, the most important thing that I took away, it has nothing to do with all of this, the capital markets, the economy, the number of players, the motivations, the risks, the uncertainty. The thing that I took away upon reflection, and you get away from some of the heat and uncertainty and anxiety and exhaustion of what we went through, was that people matter. I don't know why it didn't strike me at the time, but if you think about it, whether it's in your community, whether it's in your school, whether it's in your church, whether it's even in your family, whether it's at your work, individual people can make a difference. And one of the things I took away was that we were around a lot of different leaders. Some of those leaders were awesome. Some of them were so important that when I look back and people say, wow, look at what you did, look what happened, look what didn't happen, I think a lot of it came down to the leaders. And I think even if we had the same leaders, if they were in different seats and had different perspectives, I'm not sure we would have made the same decisions. In fact, I'm pretty sure we wouldn't have. And it came to appreciate in business and in life, and certainly when I look at what's going on around the world, you have to work into this economic or political calculus, this sociological aspect of the whole thing, that individual people matter. And one of the things that was really important that I took away was this focus on character. Now, great basketball coach John Wooden once talked about reputation of people versus character. And he said, character is a heck of a lot more important than reputation. We saw different leaders, and many of you know who they are, and you know their reputation. But character is what they really are. And character gets displayed. It's not what they say they want to be. It's not what they hope they want to be. It's not what they aspire to be. It's who they really are. And one of the things about character is it gets displayed, and it's pretty easy to look like a good leader when things are pretty good, when you have the information, when you have the time to make the decision, when most of the outcomes are pretty good. But when there's stress, when there's uncertainty, when there are really no good choices, when the clock is ticking, and you got to act, you got to lead, accountability, decision-making, the actions one takes, the leadership one provides, the true character comes out. And I learned a lot about this during the global financial crisis. So with that as a backdrop, what I'd like to do for the next couple minutes is just simply look at kind of three periods in American history and kind of use this framework to kind of assess kind of where we are, what happened. And the first one is going to go back to that clip from Hamilton. This explains all of that. This is how robust the framework is. What happened? Well, we had General Washington marshaling troops from all of these different colonies, and he had an aide-de-camp. After the war, he became President Washington. And President Washington's aide-de-camp got nominated to be the first Secretary of the Treasury Department, and his name was Alexander Hamilton. And Alexander Hamilton recognized if we were going to be a nation, we needed to harness the resources and exploit the capabilities and the potential of an economy. And that economy was pretty disparate across the colonies. But complicating that was the fact that if you want to have this economy, well, what do you need? You need a strong capital market. And the capital market was very fragmented. Different states had financed their militia. They had their own currencies. They had their own banks. And he made the proposal to say, no, we're a nation. And if we're going to have credibility with the other nations of the world, we need to have unitary financing. We need to refinance all of these colonies' debts to create a debt of the United States of America, the U.S. Treasury market. And we need to have our own currency, not different currencies in different states, the U.S. dollar. Well, you can imagine if you were from a southern state that didn't really have many debts You didn't really want to be bailing out Massachusetts, New York, Pennsylvania. Those colonies had big debts. Back, who are the players? Who are the institutions? What are their motivations? What are their risks? What are their time horizons? Well, Madison and Jefferson, coming from Virginia, they were willing to go along, but they were anxious about the cost and getting marginalized and subsidizing all of these debts of these northern colonies. So the compromise was struck. In the room where it happened, where nobody was, the proposal was made, we'll hedge the risk and we'll take the long-term view, but we'll put the nation's capital on the banks of the Potomac. And that's why our nation's on Washington, D.C. today, not Philadelphia or New York. All of that was tied to this idea of this local economy, the idea of the capital markets, the various players, the various risks that had to be assessed and a solution found. So let's fast forward 200 plus years. 2006, the economy was doing okay. And I want to kind of bring you into the yellow area back again between the private and the public, in the intersection between the economy and the capital markets. There's a relationship that is really, really important. And this is the relationship and the role that the private sector plays in the capital markets. I began by complimenting you on your intellectual curiosity, your focus, your commitment, your desire to learn and engage. When investors do that, when they ask the tough questions, when they do the due diligence, when they press to understand, they demand the transparency, they don't get disillusioned by someone speaking loud and moving their hands fast, okay? That's called, in public policy parlance, market discipline. You're not going to get hoodwinked. You're not going to get deceived. And the more of that rigor and pressure and analytical review that goes on creates a very powerful force. The other side of it is regulatory oversight. We need regulation. And having been on the private sector and the public sector, I appreciate the balance. Oh, how many of you have invested in the United States capital markets? Almost everybody. How many of you have invested in emerging markets? A good number. Why? Well, you agree of the benefit and growth and diversification benefits, that's all true. But when you invest in the emerging markets, what do you expect? You expect a higher expected return. And why is that? Because there's higher risk, and you want to be compensated for that risk. The rule of law in some of those markets isn't as great. The rule of disclosure isn't as great. And if we have effective regulatory engagement and oversight, then investors feel more confident. You don't want so much that it stifles the innovation, stifles the creativity, because then the capital markets can't breathe. You raise the cost of capital, and you reduce the economic outcome. On the flip side, if the regulators are kind of like the dopey policeman in the cab car eating donuts, you're going to have problems in your markets. And it ultimately undermines investor confidence. And when we think about the global financial crisis, it's one thing when an institution fails. The capital markets, we allow that. It's okay if a regulator misses something. It's a dynamic environment. But when both fail, what happens is this directional impact on the economy. And that risk that both fail and take out the entire economy, we describe as systemic risk. Systemic risk is the risk that the system is taken out. And so we're constantly, like every risk, thinking, what is the risk? How do we define the risks? What's the probability of the risks? What's the impact if a risk event occurs? How do we mitigate the risk? How does it evolve over time? But systemic risk is the thing that scares the daylights out of us. That's the thing that we're responsible for mitigating and not letting that happen. So kind of lean into the regulators. Make sure that the private sector is doing what they're supposed to be doing. And that's what we tried to do during the global financial crisis, but leading up to it. And so as we think about what was the state of the state, the economy was doing okay, but all of a sudden there was some smoke. In 2007, we saw smoke in a section of the credit markets where there were instruments that were very complex, very opaque, unfortunately highly rated, that people, once they started to really pick at it and understand it, they're like, wait a second, what's going on here? And then the people that owned it didn't want to own it. And then they wanted to sell it, but then the people that sold it to them didn't really want to buy it back. And it got worse, and it got worse, and it got worse. And part of it was tied to who are the players. I use the mortgage because it came up in James's comments. We had mortgage originators. Great. What's their job? Originate mortgages. Who gives them the money to do that? The banks. Well, what's the incentives of the mortgage company? Just write mortgages. They don't care about the underwriting criteria, the job prospects, the income verification. Their job is just, I write a mortgage, I get paid. Pretty simple. Why would the banks do that? Because the banks were borrowing cheaply, they could then get the money from the higher rate and make an earning. Okay, fine, but then the banks realized, well, we got a lot of this. We don't want all this. So they put it in packages, securitization, and then they sold it off their balance sheet. Oh, but before they had to do that, the buyers said, wait a second, I got to know what I'm buying. They said, no problem, we'll get it rated. They go to the rating agencies, and they said, slap a AAA on this one, no problem. But it's not really that good. And the bankers said, you don't like it? I can take it to a different rating agency. We take our business elsewhere. No, AAA, it's fine. Here you go. Off it goes. Then you get the buyer, the institutional investor in many cases, fiduciaries. I can buy it, it's AAA, roll it in. Look I get a little extra yield. I'm motivated and incentivized for performance. And all of this was playing out. And while it was playing out and we started the pressure, then we started thinking through, what are the implications? Who owns this stuff? Where is it? How's it accounted for? It was so opaque and so complicated, it was really hard to understand really where is the risk. And then when we talked to the institutions that had some of this, whether it was off their balance sheet or on their balance sheet, then they were trying to hedge it. But they were hedging it with derivatives, and there was no transparency around the derivatives. So we couldn't even tell who other people's counterparties were, nor could they. And then all of a sudden you start to see this web get uglier and uglier and uglier. And all through that time, we're saying, oh my goodness, look how much leverage is in the system. Better try to get people to start to delever, start to lean on the regulators, try to raise more capital, try to improve transparency. And it went on and on and on, and problem after problem start to encroach. In the spring of 2008, we started to see this impact then the investment banks. And one of the important aspects of this is confidence. And if there's a breakdown in confidence, things can unravel very, very quickly. And we saw that happen literally within days of one of the major investment banks. And it was really a 24 to 36 hour scramble. At 5 a.m, we finally got a potential solution and got the secretary and the chairman of the Federal Reserve to sign off on it to mitigate the likelihood that this investment bank declared bankruptcy the next morning with all of this counterparty credit exposure that no one knew where the heck it was. And what the implication would be, and our concern was this could be a systemic event. And we dodged that bullet. And then we started focusing on other issues, and then we recognized that one of the biggest problems was right in Washington. We had 2 of the largest financial services companies that were much more levered than any investment bank, who also had the most concentrated exposure to the mortgage market. And if these ones went down, it really would have been a systemic event. And we came up with a plan, a clandestine plan, we briefed the president on and executed over a weekend to take over Fannie Mae and Freddie Mac. Mitigated a second systemic event. But things continued to get worse and worse and worse, and it was exhausting. I mean, we were working so hard, but institution after institution failed, and the credit markets got worse and worse, the leverage issues, the transparency issues, the pricing issues, and the stress was unbelievable. And now I'm going to take you into the room where it happened. This was in September of 2008, and every morning I was at the office. Many nights it was just overnight, but this morning I was in my office about 5 in the morning talking to investors in trading desks in Europe, then around 7 a.m. in New York. And I had a lot of different contacts. I oversaw the Treasury market and oversaw the President's Working Group on Financial Markets and the Advisory Committee for the Treasury. And I had a lot of contacts, and I had people whose judgment I had a great deal of respect for, and I knew certain people had preview into much broader areas. And I was talking to them, and this morning I heard some things that I hadn't heard before, and that was unusual. I thought I had heard it all. And I heard some things that really scared me and really troubled me. And I hung up with one, and I called this other person, and I started asking some innocuous questions because I don't want to tip anybody off. I'm always like, hey, how you doing? What are you hearing in the Treasury market? It was kind of my standard opening because everybody knew that was the transparent market. But then I'd ask some more questions. And I realized it's not just about what's going on in the markets. Now it's about what they're doing with their institutions and their fear that was in their voices and the actions that they were taking were going to hurt the system. And this was the first time I had really heard this. And about 2 minutes later, after I hung up on the second person, I was going to call a third person, and I hear a car come up. And right outside my window on the corner of the Treasury building is where the secretary comes in. And so the Secret Service brings in the secretary, and every morning he would come up, he'd stick his head in my office, and he goes, Tony, how are we doing? And this morning, I just shook my head. And his face visibly changed. And he goes, what's going on? And I'm on the phone now. This person's answer, I said, hold on. I said, Hank, I'll be up in your office in 2 minutes. I said, it's bad. And he goes, what's going on? I said, I'll be up in 2 minutes. And he was not a guy that didn't like to get answers when he wanted them. But I said, 2 minutes, I'll come up. And I get off the phone, I go upstairs, and I run up the stairs. His office was literally right above mine. And I walk in his office, and his back's to me, back's to this door. Behind his desk is a credenza, and on that credenza are all these monitors. Now, he was the chairman and chief executive officer of one of the biggest investment banks. He knows markets, he knows financial institutions, and he's looking. And I walk in from behind him, and I said, you're not going to see it on the screens this morning. What I'm going to tell you, you'll see on the screens in a few hours. And I tell him what I'm hearing. I tell him what I'm fearing. And now I see his face reflect the same anxiety. I said, this is it. Today's the day. This is the systemic event that we've been working so hard, so long, so diligently on to mitigate. And I don't know what to tell you. I don't know what to advise you. And I said, but maybe I'm wrong. I hope I'm wrong. But I said, why don't we call Ben, Chairman Bernanke, because I said the Fed's got so much more insight. They have many more resources than we do. Maybe I'm overreacting. So he calls out to his assistant and says, get me Ben Bernanke on the phone. This is like 7:05 in the morning. Ben's on the phone in 30 seconds. She goes, pick him up, line 2. Ben, it's Hank. Tony's in my office. He's walking me through what he's hearing and seeing in the markets. He's taking my breath away. And Ben goes, Hank, my guys are telling me the same thing. I'm on my way over. About 15 minutes later, I see the Chairman Bernanke come in. He walks right up into Treasury Secretary Paulson's office. I'm there, and I'm going through. He's there. One of the Fed governors had joined him. David and other members of the domestic finance team come in, and we're going through, and it is our worst nightmare. And we're trying to figure out, what do we do? what do we do? What actions can we take? We had explored so many ideas, and then ideas would get floated, then debated. And about this time, the secretary's chief of staff comes into the room. Hey, what the heck's going on here? He was looking to take the secretary out for some trade association breakfast. And he sees us. He sees our faces. He hears the tone. And he goes, what the heck is going on? And the secretary says, today, this is it. This is what we feared. This is as bad as it's going to, this is the worst it's ever been. And the chief of staff says, if it's really that bad, you got to let the president know right away. And he says, you're right, you're right, you're right. So he calls out to his assistant. He says, get me the oval. She calls back, line 1. 10 seconds later, bang. Josh Bolton, the president's chief of staff, goes, Hank, it's Josh, what's up? And Hank goes, Josh, I got to brief the president. The financial markets, today is the day that I've been worried about. This is the situation. And you hear this, okay, paper flipping. Come on over at 10:30. Okay, great. No goodbye. I mean, just we're going. Now we're debating, we're discussing, we're thinking about it, what recommendations, what actions. Ideas getting floated, batted down, assumptions challenged. Then all of a sudden we all look up. And standing in the doorway of the secretary's office are 2 big Secret Service guys. And he goes, we got to go. And we're like, go where? And he goes, we're doing the Oval in 5 minutes. We're like, oh my God, where did that time go? How did this go so quickly? We have no plan. We have no consensus. We certainly don't have any paper. We never met with the president without putting a little presentation in front of him and walking him through it. And the Secret Service guy's like, go. It's Chairman Bernanke, Paulson. Paulson goes, you're coming with me. So I'm like, oh gosh. So I run down to my office, grab my suit jacket, put it on, see the secretary and the Secret Service and the chairman come down the stairs, zip out, go out the west side of the Treasury Department, which is right next to the White House. We cut through the residence, we go underneath, we go zipping in, right into the West Wing. And here's where the room where it happens is the Roosevelt room. President Bush used the Roosevelt room. It's about the size of a dining room, and there's a dining room table in the middle. You've all seen the picture of it. There's a picture, an oil painting of Teddy Roosevelt and the Rough Rider, San Juan Hill, and in the corner is the Nobel Prize that Teddy Roosevelt won. And we get in there, and we'd been in there for briefings with the president before. We all knew our assigned seats, and we knew what seat he was sitting in. And just as we were getting in there, the president comes in, sits right down. His team's on the other side of the table. And he goes, what's going on, Ryan, in the markets? Because he was told there's an issue in the financial markets. So I gave him a very brief overview of kind of what was going on, what our concerns were, what we were seeing, what we were fearing. He asked a couple of follow-up questions. Then he looked at Hank Paulson, and he goes, Hank, you know these guys. You know these institutions. What are they going to do? What does this mean? And the secretary said, they're in trouble. They're in big trouble. It's out of their hands. This is the fear we had, Mr. President. So the president then turns to Ben Bernanke and he says, Ben, what do you think? What's this going to do to our economy? Ben Bernanke was a student of the Great Depression. He won the Nobel Prize for it subsequently. But he said, Mr. President, this is it. He goes, this is going to have massive economic outcome. And this is a systemic event. And Mr. President, it's going to be global. And Mr. President, it's going to be worse than 1929. And he says, what can you do? And Ben Bernanke says, Mr. President, he said, you know how hard we've been working. You know how diligent the partnership has been between the Treasury and the financial markets and the Fed. All the work that we've done with these credit and lending facilities. He goes, I have explored and utilized every single authority and power I have, and then some. He says, This is no longer a monetary policy solution. I think we need a fiscal response. The president turns back, he goes, okay, Treasury, you got a recommendation? So I'm like, oh boy, what's coming? I look over to Ben Bernanke, and Ben's looking at me like, what's Hank gonna say? And Hank says, Mr. President, we need capital. We need a lot of capital. And Treasury doesn't have a balance sheet. So we need to get your permission to go up to Congress and ask them to give us the authority for capital. And the president goes, well, do you know how much you need? What's a lot? And of course, we had been kicking numbers around for the morning, lots of numbers and no settled ideas. Again, I look at Ben, and Ben look at me, and Hank comes out with $700 billion. And the president goes, 700 billion? Did I hear you right? And Secretary Paulson said, yes, sir, Mr. President, $700 billion. And he goes, do you know that $700 billion is equal to the entire budget for the Department of Defense? And the secretary goes, yes, sir, I do. And he says, so you want $700 billion, you want Congress to basically give the Secretary of Treasury a blank check for $700 billion. Yes, sir, that's what I'm asking for. I was, okay, let me ask you a couple more questions. He says, what are you gonna spend it on? And again, lots of ideas kicked around the Treasury. Looked at Bernanke, and I shrugged my shoulders a little bit and wondered what Hank was gonna say. And Hank says, well, Mr. President, not really sure. We got some ideas. And he says, we might buy some of these troubled assets and help clean up the balance sheets of the financial institutions so they can start lending again and mitigate this systemic risk. But there's problems with that. Maybe the other idea is capital. And that hit home. Dead silence. I'm looking across at the president's team, the vice president, chief of staff, the president's senior advisors, and they're down looking at their shoes. They couldn't believe what they were hearing from us. And the president looks me right in the eye. And then he looks at Paulson. Then he looks at Bernanke. And he knows how hard we've been working. And he says, I'm glad this is us. And I'm thinking, what the heck? I mean, I know he's been working hard too, but we all must be losing our minds. I mean, did I hear him right? He's glad it's us. I think all of us wouldn't want to have to be in this situation, in this room, at this time, with this situation. And then the president said, here's what we're going to do. He goes, I've been working with this team now for a few years. He goes, I know you guys. I know how you feel about capitalism. I know how you feel about free markets. I know how you feel about our economy. So here's what we're going to do. We're going to do this, and we're going to get criticized to the high heavens because we're going to take U.S. taxpayer money and put it in U.S. private companies. But we're not going to stand on our ideals on some academic theory and do something for that purpose. We got a job to do, and that's to do what's the right thing for the American people. We got a job to do, and that's the right thing for the American economy. And while it violates all of our kind of operating principles and beliefs, we can't shy from this. We're going to do it. And I am glad it's us. So here's the deal. You guys get up to the Hill. You tell the Speaker of the House. You tell the Senate Majority Leader everything you just told me. And then you ask them answer every question they ask you. And then you tell them that they have to do this. And you need that legislation done and on the president's desk tonight. They're not going to want to do it. They're going to criticize it. They want to distance themselves. We have to do this because you're telling me it's the right thing to do for our economy. Again, silence. And then the president said, "What are you waiting for? Get up, get out of here. I got something else I got to go do." So we got the heck out of there pretty quickly, got the team up to the Hill. Then a few hours later, the president went out to the Rose Garden.
The prize rests on the conviction that the federal government should interfere in the marketplace only when necessary, given the precarious state of today's financial markets and their vital importance to the daily lives of the American people. Government intervention is not only warranted, it is essential. In recent weeks, the federal government has taken a series of measures to help promote stability in the overall economy. To avoid severe disruptions in the financial markets and to support home financing, we took action to address the situation at Fannie Mae and Freddie Mac. The Federal Reserve also acted to prevent the disorderly liquidation of the insurance company AIG. And in coordination with central banks around the world, the Fed has injected much-needed liquidity into our financial system. These were targeted measures designed primarily to stop the problems of individual firms from spreading even more broadly. But more action is needed. We must address the root cause behind much of the instability in our markets. Mortgage assets that have lost value during the housing decline and are now restricting the flow of credit. America's economy is facing unprecedented challenges, and we are responding with unprecedented action.
He said at the meeting, as we concluded, "I'm glad it's us. I got your back." And he did. And I'm forever grateful for that. And I think it says a lot about the president's character at a time when all of us were so stressed. He helped us move it forward. And that legislation ultimately resulted in TARP, and that created capital that kind of refinanced all of our financial institutions and mitigated the systemic event that we were so concerned with. So with that, let me conclude and invite David up, and then we'll do some Q&A. And I recognize I kind of went a little longer but that's kind of what Irishmen do. And then we'll open it up, so I want to make sure we get to your questions as well. And we'll talk about this framework that I reviewed, and we can kind of really, I think, in a sense, apply it to kind of the state of the state today. Where are we? What does it mean? How do we think about this? And James told me that this audience is really thoughtful, really insightful, and really capable. So I said, that's great. Given what's going on in the markets tonight, I have a lot of questions I need to ask. So, David, come on up.
So I don't know about you, but I'm miserable thinking about that period again. And it brings back a lot of goosebumps. And Tony and I haven't been in the same room for a while, but when we're in rooms together, bad things also happen. So this could be rough. And actually, it is rough what's happening in the markets right now. So you brought us back to the room. You showed a lot about the character. And I do want to talk a little bit about some leadership lessons that we saw. But I think what's most important, and we think about this a lot, is you talked about the framework. You were in the room, I was in the room, we were there. What the heck happened? Like, what caused the financial crisis? And implicit in the question really is, how do we prevent one from happening again?
Yeah, I think, as I noted, it was kind of a breakdown on both the private market sector and the regulatory environment. And so let me just pick up on the regulatory side, because I think in some ways, one of the things we recognize is that the regulators, that we've had lots of crises, and they are not going to go away. We're going to have more crises in the financial markets. So I think we just got to bake that into our expectation set. And what the regulators, if they're good at something, it's fixing the last problem, looking at some of the root causes, figuring out why it happened, and then providing additional guidance, new guidance, or if it's not the regulators themselves, it's Congress. We talked about the different roles and the different players. Congress has a really important role. They are in charge of making laws, and new laws emerged. And some of the policies and regulatory environments that existed at the time have been replaced, and some of that have made our financial markets more secure. We see what's going on with the banks, and sometimes they lean in, and this is why you see some of the bank executives saying it's overly restrictive, it's too much capital, too much reserve, too much safety. If we didn't have these regulatory burdens, we could do more lending, more credit extension, and that would enable economic growth. There's just always this balance, and I think the other important thing is it's never static. It's never static, and things are constantly evolving, and I think when we look at kind of where we are today, we should expect that the Congress will continue to kind of engage. And you already see this in some of the things that are happening today in terms of the Congress now leaning in on the tariffs and the right of the president to do certain things. And if it's not the Congress versus the executive branch, we also have the courts. And we see the courts kind of stepping up and expressing kind of their role and responsibilities. But while we can kind of look at the federal government and the various branches and the players, we don't get a free pass. The fact of the matter is a lot of people did a lot of silly things, and they became complacent, and they eroded that market discipline that's so fundamentally important. They were buying things they didn't understand. They were looking at things, getting these 150-page prospectuses and kind of throwing them away and then buying the credits. And so the policies, the practices, the protocols, the incentives all get revisited. So I just think the framework is robust, whether we're talking the 1790s, we're talking 2006, we're talking 2025. You got to look at all the players, their incentives, their alignments, and have a much better and healthier appreciation for risk. And we see this when volatility is very low, people start to get complacent. And we used to describe it at Treasury as sometimes priced for perfection. It's okay where it is, as long as everything's perfect. But things aren't perfect. And when things go into some disequilibrium, some real surprises can occur if that level of due diligence, risk management, and conservatism isn't also baked into the equation.
Yeah, I think one of the things that, and Tony, you said this, but I think it bears repeating, which is you took us through 2007 to 2008, but one of the real things that turned the tide was when we realized this was systemic. And the financial crisis was really a crisis of confidence in the banking sector, because through the period of time where Bear Stearns was taken over by JP Morgan, there was this long period of time where we thought individual institution solutions would work. And so Bear Stearns was saved, and then banking solutions were provided by the FDIC. And then we ran into a series of other successive acts for single institutions. But what really happened over time, and this is what you said, was we lost confidence. And the moment that the market lost confidence in the stability of its banking system was the turning point. And that's when we needed to go to Congress to ask for the tools. We needed to ask for more authority because we weren't really prepared to do it. So that's my next question, which is, you talked a lot about the framework and the people. I think it would help to tell the group, what are the tools that we had at the time? Why were they deficient? How did we look at those tools? And how are we set up to prevent a crisis going forward in what we learned in that period of time?
Yeah, I think a lot of the tools that we had at the time were tools that were given through legislation for the institutions to deal with prior crises. And the new crises had different root causes and issues. That being said, we had a boss, Secretary Paulson, who was very broad-minded and was constantly pressing us to think about what are the authorities, where could we go? And sometimes in law, there's ambiguity. And sometimes you can take advantage of the ambiguity. And in a crisis, yeah, we did. And sometimes we got our hands slapped for that. But we did it well-intentioned. We did it because we had a broader objective. But there was some legislation, and David, you'll remember this, that goes back to many, many decades earlier, when the Treasury used to kind of intervene in the currency markets, and they had this fund that was put aside for exchange rate stability. Well, you may recall during the global financial crisis, one of the issues that we had at one point, among many, was people had money in money market mutual funds, and they were, again, reaching for a little bit of yield, a little bit more yield, a little bit more yield. But then all of a sudden, maybe they reached a little too far, and the fund was going to, quote, break the buck. And that would have been catastrophic because of the amount of capital that corporate funds had in Treasury, in the money market funds, individuals, et cetera. And we didn't really have a solution for it until David and his team came up with this idea, well, maybe we can come up with an insurance program. And well, where are we going to do that? Well, a buck, exchange rate for the dollar, buck. Yeah, we got a solution. And we used some authority that probably Congress didn't intend to be used for that purpose. But we wanted to tell a little bit about how that ended.
Well, they prevented us from ever doing it again.
Yeah.
They literally wrote in the law that was not allowed again.
Yeah,
And,
so
that was.
the House Financial Services
They
Chairman
reminded
was pretty upset.
But
But it worked.
It worked. Well, who would have thought that money market mutual funds would have Lehman Brothers commercial paper in them? And that was one of the reasons that money market mutual funds were breaking the buck. Another really kind of interesting, so Tony said it well, which is laws of the past that were written of the past were not good enough for the times of the future. So you talked about the housing market and the GSEs. So the GSEs had about $5 trillion of liabilities, both paper that they owned and securitizations that they provided guarantees for the financial market, and they had 1/500th of the capital to provide for that. So when we told Secretary Paulson that we had to have a program with which to support the GSEs, his first question was, well, that's fine. There's a line of credit. It's written in the law that you can back the GSEs. I said, yeah, do you know what the limit of the GSE credit is? About $2 billion each for $5 trillion of liability. So we had to go to Congress and beg and say, we have no tools to provide any support whatsoever. Like no tools. And that was the first iteration that we went to Congress to ask for that.
Yeah, and I think there's always lessons learned, and the academics go after this, and other people, even Congress, to figure out how do we improve and enhance and facilitate stable financial institutions, the safety and soundness of the market infrastructure, and Congress does work to try to figure things out and make things better and work with the regulators. But everybody's part of the problem and everybody's part of the solution. And you have to have that kind of, I think, self-awareness and self-confidence to recognize, okay, we got to do things better. And we also learn from other institutions and histories. We see crises in other countries around the world. There were a lot of issues that were related here. We think about it, and I noted through the eyes of the United States, but I spent a lot of time talking to foreign finance ministers. Where do you think a lot of that securitized, CDO'd squares and everything else ended up? Balance sheets of German banks and other places. And so a lot of this were, when we talk about trade, well, this was one of our exports. When we had this situation with Lehman Brothers, I think a lot of people felt like, well, why'd you, number one question I got when we got done was, well, why'd you let Lehman fail?
Yeah.
And I'm like, you don't understand. That's a false question. It's a false premise. We didn't let Lehman fail. We couldn't stop it from failing. Okay? Then we said, well, wait a sec, that doesn't make sense. That happened 6 months after Bear Stearns, another investment bank. And you kind of saved that. And I said, we didn't save that. Jamie Dimon bought it. And we helped facilitate some of the financing. Yes, the Fed did. And that helped mitigate that systemic risk. But in the case of Lehman Brothers, we didn't have the balance sheet. We didn't have TARP then. And even if we did, and the Fed didn't have the ability, given the credit quality of the assets and the amount of leverage, but we did work to try to replicate the solution that we came up with Bear Stearns, with Lehman Brothers. But interestingly, it was by an acquisition of a foreign bank, and the foreign regulator said, no way. You're not importing that toxic capital market implication to our capital markets. And that's why the deal fell through and there was no alternatives. But it wasn't as if we worked really hard to mitigate. Again, we were worried about the systemic event. Everything came back where we focused on individual institutions, it was always at the risk of a systemic event. And that was the motivation that drove us in terms of the policy actions that we took.
Yeah, Lehman had $600 billion of unsecured liabilities, and we had no ability to cover them. JP Morgan covered the $300 billion of Bear Stearns. So I get that all the time because we always get the same questions. Why'd you let Lehman fail? It killed us to let Lehman go. And we actually thought we had a solution with Barclays. And like Tony said. So we got to get to the future, and we got a couple of minutes, and we got to get to your questions. But I think it's probably worth just one moment to share a moment of leadership and character during the crisis that you saw.
Well, I think the president and the secretary are kind of the top of the list for us in terms of every single day, the time, effort, and dedication that they put in, and the appreciation they had for the team. I mean, David and I can talk, and I'll give you a quick little story. After the GSE, and this was something we worked very closely with, but it had to be done in private, because my biggest fear was that if that leaked out, the GSEs, Freddie and Fannie, were the biggest issuers in the world after the Treasury Department. In fact, I used to have to coordinate the issuance of treasuries with the financial institutions in terms of their balance sheet, in terms of what they could take down and then move. That's how big they were. And their paper was owned by every sovereign wealth fund that owned U.S. treasuries. And we needed that support. And their paper was also a big part of the capital of most of our major financial institutions. So we couldn't let them fail. And this was well after most of the private banks had all pulled out of the mortgage market. And we needed mortgage credit. So they were the only game in town, literally. And yet, they were going to fail. And if they failed, all of the defaults were going to take out the bank's capital. They were going to kind of ruin the trustworthiness and relationships we have with foreign investors, the dollar implication, the treasury market implication. So we put a plan together to take them over, to fire their CEO, their chairman of the board on Friday night at 4:05 after the markets close. The government comes in, we take it over, and we're doing auctions for Freddie and Fannie on Monday morning, and maintaining, and then ultimately starting to delever, but then we took ownership of that on behalf of the US taxpayers. But the Monday morning after that went, and it all worked, and we were all holding our breath, went into the Oval Office to brief the president. And he was pleased, obviously, with what we had done. And he thanked me. And I said to him, well, sir, thank you very much. But he said, you need to know that we have a team at Treasury who've been basically working on this for weeks. And they executed flawlessly. And it's really the team that deserves the credit, but I'll be sure to pass on your appreciation. And 2 days later, I get the secretary's chief of staff comes to my office. He goes, I need you to go to this room over on the 3rd floor of the Treasury Department. And it's where the foreign diplomats all go. I'm like, who's coming? Why do I have to go there? This can't be fun. So it's a big room. It's about the size of this room. And I go, what time? And they said 10 o'clock. So I said, okay. If I need to go, I'll go. And then I said, well, who's going to be there? What do I need to do? How do I prepare? He goes, oh, you'll be fine. Just go. I'm like, that's a classic chief of staff. So I walk into the room at 10 o'clock. The door's closed. I open the door and I walk in, and there's the whole team, 30 people. Everybody from the guy who used to make David and me peanut butter and jelly sandwiches and bring us pots of coffee to kind of everybody on the domestic finance team. And they're looking at me as a senior officer. I'm like, what the heck? Who called you guys? They're looking for me to say something. And I didn't even know what the meeting was about. So now I'm like, okay, I got to figure this out. So I'm sure the secretary knows. So I open the door and I start to go out the door down the hall to the secretary's office. And some guy goes, get back in the room. He was about this big, shoulders like this, suit coats popping out. I'm like, got it, I'm in. And I walk in the room and they said, look, so what's going on? I said, I have no idea. And 15 seconds later, the door opens and in comes the president. Now, if you know anything about Washington, you know that you learned about power. You go see the president. You go to the Oval Office. And the president's coming over. And he opens the door and he says, good morning, everybody. He He goes, yesterday, Ryan here was in my office, and he wouldn't take the credit for everything that you guys did. And he goes, so I came over because I wanted to thank you personally.
Yeah. Yeah.
And he said, he brought his photographer, and he goes, come on, everybody line up. I want a picture with each one of you.
Yeah.
And he couldn't have been just, so I think about leadership and character, and you don't really get to know some of these kind of people that are in the public eye until you work with them. And I am forever grateful for that, the opportunity. And I learned a lot as a business leader about the values and importance of working with people and appreciating what people are doing and the sacrifices that they're bearing to execute a mission. And I'm grateful that I had that privilege and honor to be in the public service.
Can I give you one too? Because I think it's super important with all we're dealing with today with crisis in the markets. It's important to think about some of these character issues. And back in this time, remember, there's a political election and the Republicans lost. So Obama won, and it was a pretty competitive campaign, and we were done. We were ready to go. We were exhausted, absolutely exhausted. And I don't know if you remember what happened at that point, but so Citigroup went down, they needed more capital. Bank of America went down, they needed more capital. Citigroup got a big guarantee, but then the autos started to fail. And Chrysler's financing had dried up. Everyone except Ford needed credit. And we didn't want to do anything else. We wanted to be done. And Secretary Paulson said, nope, this is our problem to solve. We are in the seats. We need to solve this. This is not what TARP was created for. There was a massive debate about it. He's like, I'm going to convince the President of the United States that he needs to do this. They went to the White House. They asked a question as to whether we should do it. There was a vote, and there was a vote. I'm not going to tell you who voted no, but some did vote no. And the Secretary said, you need to do this, Mr. President. And the President of the United States said very clearly, no one knows what it's like to be prepared to sit in this chair. We are not going to leave President Obama with the destruction of the auto industry. And we lost all that money. And we knew it was a bad investment.
It was going to be redeployed.
We knew it was a bad investment. But we had to recommend the investment because we couldn't leave Chrysler without any financing. We couldn't leave GM without any financing. And we actually put the automakers on a path for sustainability. So when President Obama says this administration has never lost a dollar in his investments in the auto industry, that's because we put him in the position to actually saving the auto industry by putting ourselves at personal risk. But that was character.
Yeah, absolutely.
Because he could have had a political solution for that. And he didn't do a political solution to that, and neither did Secretary Paulson. So it was pretty amazing. So we should do questions, I think, right?
Yes, and reading this verbatim from online. Now we have a president without character. Would you own equities?
That's definitely for Tony.
They went right for it.
That's definitely for Tony.
Okay, so the question was, I'll just repeat the second half of the question. There was a statement in a question. The question was, would I own equities? Would we own equities? Yes, of course. Look, equities are, think of where they sit on the capital structure of the balance sheet. They're risky by nature, okay? But what does equity represent? Equity represents ownership, and you have ownership of the best institutions in the best economy in the world. So would I own equities tonight for tomorrow? Maybe, maybe not. But if you're going to own equities, you should own them for the intermediate to long term. And it's hard to believe that the U.S. economy isn't going to continue to be the strongest in the world, and you want to be a part of that. And what's the alternative? Equities are also kind of a real asset. And so in terms of growth, in terms of economic prosperity, yes, I think for almost all people, a little bit of equity is a good thing. And if you have a long enough horizon, maybe a little bit more than a little, would be the way I'd answer that question.
David, nice dodge.
I would own equities too.
Thank you for coming. Appreciate having you in Vail. My question is two parts. I understand why you had to take Freddie and Fannie over. I disagreed with it at the time, but I understand it. What about now? It's been 17 years. Is it time to privatize Freddie and Fannie? If so, why should we? If not, why don't we? The second part of my question, in 2010, President Obama took over Sallie Mae all of the student loans, and that became a part of the federal government. What about privatizing that as well?
Yeah, this is a really interesting topic. I think you almost have to go back to why did these things even get started? And I think you ask the fundamental question, well, what's the role of government, and what's the role of government with these types of institutions? What are they trying to achieve? And I asked the same questions, and I think part of it was, well, in terms of the American economy, the belief, and I think in some ways it was a paternalistic belief that we'd be better with communities and better with housing, and we should kind of influence consumer behavior by subsidizing housing. And that's what led to the creation of Fannie and Freddie, and then student loans and these other kinds of things. I think when government tries to create economic incentives, sometimes they create disequilibrium in the capital markets, and whether or not they're best positioned to think about how to deploy capital. We've seen it on a lot of different government programs in terms of trying to stimulate different types of entities, whether it's through corporate tax credits, whether it's through direct investment. There's conversations and discussions about a sovereign wealth fund. I mean, so all of these things, I think you have to go back to kind of first principles and say, kind of, is that really right? Why housing? Why not American automobiles? And maybe this is part of the rhetoric today. Or what else is next? And why is the government trying to do that if we're a republic democracy associated with a market-based economy? Let citizens choose what they want to do and how they want to finance it, and let the market dynamics go out to price that. We were worried about the systemic risk event and the fact that there was no mortgage credit, and that's why we moved them into conservatorship. And yes, that's created a phenomenal return because we took over the equity on those. But I also think about that the construct of that was, I often described it as the Bermuda Triangle. This is not a good model. You had Congress, who had a very strong interest in housing, and in Freddie and Fannie particularly. You also had a very weak regulator who was compromised by some of the congressional interests. And you had, to make it interesting, let's make it a public company with a board of directors and shareholders. Now think about that if you're the CEO and you have all of these different stakeholders, and goes back to the conflicts of interest. How do you align these? How do you manage these? How do you assess these? What is the objective? Are we trying to maximize shareholder wealth like we're a public company? Well, yes, today. What about tomorrow? No, we're trying to subsidize housing and follow some social agenda. Or what about the regulator who's trying to kind of get more structure to protect safety and soundness? So it was a tough construct. And I just think as we think about where the government goes, I think it just goes back to some of those first principles and say, what role do we really want to play? Are they good allocators of capital? Maybe not. Their track record wouldn't suggest that they are. And maybe it's better left for the marketplace to work those things through.
But some of the key questions will be, I'm proud that I testified before the financial crisis that they were going to be a crisis before it happened, before Congress, so I have that on record. But here's the real question as to whether or not they'll be privatized. The question will be, does the political process allow mortgage finance to be more expensive? Because for them to be private, the amount of capital that they'd need to raise in order to truly be independent of the government's implicit guarantee will be larger than the current structure will allow them to price mortgage guarantees at the current pricing. So I think the issue is going to be, will they be quasi-private again? I think probably the Trump administration wants them to be, and they likely will be. Will they raise enough capital to be completely detached from the implicit guarantee of the government is the big question. And if they raise $100 billion of capital each, then the answer is yes. If they raise less, which probability is they will, the answer is no.
From our online audience, do we have the tools today to deal with the likely problems we face now and going forward?
We have some. We have some. I would say two things, and then I'll see if Tony has other thoughts. The interesting thing is the technology that we used in the global financial crisis that we were a part of, how to inject stability into the financial markets, how to provide liquidity into the commercial paper markets, how to use the Federal Reserve's power of lending of last resort authorities, all those types of things, those were reused again for the pandemic. So the programs and policies that we placed to inject a lot of liquidity into the market, and frankly, the Fed expanding their balance sheet to bring rates down, which is another conventional way to ease monetary policy, were all brought about by the actions that we took in 2008. So are we really good at providing liquidity into the markets when it's needed? Yes. What we can't do is if we have another massive crisis in our banking sector where people just don't believe in the banks. Banks depend on confidence. Every bank is susceptible to a run some way, shape, or form. And so we are still not set up. There is no TARP. There is no way to provide equity to banks again without more authority. So if there's a complete collapse in the stability of the banking system, we're not prepared. But are we prepared to inject liquidity into the banking system if credit freezes? Yeah, we're pretty well set up, and we did a lot of the work to do that.
Yeah, I think David's points are spot on in the sense that, we created some new chapters, some new playbooks. And so when these other crises emerged, subsequent to the time that we were at the Treasury, they had playbooks on the shelves where we were making it up as we were going along. That's how we got all the gray hair. But to say that we have all the tools that we need, who knows? Yeah. The general answer to that should probably be no, because we don't know what the next crisis will be. I mean, there's a lot of, this is what I mean, we're operating in a dynamic environment. What is the fact, what is the implication of crypto? How will that play through? Artificial intelligence, the implication and the utilization of that, cybersecurity. So it's not, certainly the banking sector plays an unbelievably important role, but what about the infrastructure? And there have been enhancements there in the repurchase market, in the currency foreign exchange market, the margining of the exchanges and other in the derivative space. So there's been a lot of enhancements that have improved the safety and soundness of the system and the financial institutions. But we shouldn't kid ourselves and think, oh, we got it now, we got it right this time. Because that's been said about 40 times and we're about 0 for 40 in terms of preventing the next one. And this is why we play a part of the role in terms of the due diligence, in terms of the vigilance that we have to play as some of the providers of capital, both as individuals and as institutions.
It's why you need courageous people. Like I hope people are prepared for the next one, because you're 100% right. We thought it was going to be derivatives. It certainly wasn't derivatives that caused it.
Yeah, hindsight's great, but what do you think today's economy would look like if you had not been able to secure the $700 billion and inject that into the banks and the economy? What would the markets and the economy look like today? It's a big one.
It would, I asked Ben Bernanke that question, and it was the banks would be just one of the casualties. I think the economic damage was staggering in terms of the estimates that the Fed had in terms of the implications. And again, it wasn't just nationally, it was globally. And the interconnected nature and the implications associated with capital would have been, it's hard to even fathom, candidly. Now, I will say this, we are resilient. We are creative, we are innovative, we work through things. So this is, if I have to leave you with a concluding theme, be optimistic. Be optimistic. We're going to work through these issues. And we got volatility in the capital markets, but we've seen this movie about 20 times, right? We saw this with the TNT bubble in 2000. There's more to the story here, and it's going to play out in the weeks and months and maybe years ahead. And there's uncertainty, but it's not unprecedented in any way, shape, or form. And we have so much to gain, or the flip side of that is so much to lose, if we don't continue to ensure that our capital markets are the best in the world, that we continue to innovate, we continue to facilitate entrepreneurialism, creativity, creative destruction, competition, whether it's in the capital markets or the economy, not just locally, regionally, nationally, or globally. And as I look around the world and travel around the world and work with investors around the world, there's no place you'd rather be. As challenging as some of the issues are, I always say we have the self-awareness, we have the self-confidence to recognize we can do better, and we work hard to exercise maybe the most important self-discipline to make the necessary changes. And this is why David's point about courage is an interesting one, because we need good people in government. And so besides leaving here confident, I want to remind you that you have the luxury, the privilege of being part of the U.S. capital markets, being part of the U.S. economy. But with that also comes responsibilities. And you have that as citizens. And to kind of think about the opportunity you have to vote and look at people and their economic policies and their practices and their expectations. These things matter, and you're seeing it play out. And it's real. And you also have the responsibility as individual investors to do the right thing. And many of you serve on boards. And hold those boards and those endowments and those trustees accountable for doing the due diligence. Ask the follow-up questions. And that market discipline helps make our capital markets better. It makes our economy better and positions all of us to be more effectively contributing to this system. And we want to contribute to this system. We don't want to leave it to government. The market-based free economy has proven to be, look back, whether it's from Hamilton's time through the Civil War, World War II, the time that we were in Washington to where we are today, there's no economy that's kind of has more potential, let alone more accomplishments than ours.
Yeah, the only thing I would add is it took about 15 years for the non-US banks to recapitalize themselves. So that's the proxy. You can just say, how long did it take? Now, we recapitalized with taxpayer money, which we did get a decent return on for, just so everyone knows. 8.5 to 8.9% return is your taxpayer money on that. But it did take, because they didn't do a broad-based program outside the US, and there's lots of reasons why they didn't, it took those banks a lot longer to recapitalize.
Okay, we're going to take a pause, and I'll give all of us a chance to thank David Nason and Tony Ryan. You guys get 2 applauses tonight. So if you need to leave, now is an appropriate time to politely vacate your seats. If you have more questions, and I know there are hands and we have a lot online, feel free to stick around for another few minutes and we'll field some more questions. Okay. I saw a hand here and then there was one back on that side.
Wow, okay.
Go for it.
Go ahead.
Go for it.
All right, Tony and David, I can't thank you enough for being here today. It's been a really great presentation. So the stock market drawdown in the last several weeks of 10 to 20% is probably an appropriate drop, given the tariffs. Given your experience with the great financial crisis and the 50% plus drop in the stock market at that time, what do you think will happen to the financial markets if we enter an actual constitutional crisis? And what probability do you put on that outcome?
It's the easy ones now.
I think I'll take the second part. I think the probability of a constitutional crisis is low. I think things get challenged, okay, and pushed and pressured. But speaking to people in Congress, they know their role and responsibility. I think one of the benefits of the forefathers is, and there were nights that I went to bed thinking, my gosh, they were idiots. And then there were nights I went to bed thinking, thank goodness they were so thoughtful. It works. It's, as Churchill said, not necessarily the prettiest thing. You heard about how the game gets played, the sausage gets made. It's a pretty good analogy. It's kind of not so pretty sometimes. But at the end of the day, when I talk to people in the military about kind of their issues and their roles, all of the senior officers that I've talked to said, our oath is to the Constitution. When I talk to the senior people in Congress, they feel very strongly about their role and their autonomy, and you're starting to see some of that actually manifest itself in actions. You also hear the same thing from the court and you see the Supreme Court, stepping up. And so there's testing going on. But again, this isn't unprecedented. If you understand and read presidential history, presidents have always kind of pushed, and Congress has pushed, the courts have pushed. Everybody's pushing at some time. This is the dynamic nature of all of this. So in terms of a constitutional crisis, I think at the end of the day, the fabric gets stretched but doesn't tear. In terms of what would happen in terms of the capital markets and that kind of it, I think a lot just depends on kind of what the nature of that crisis is. Who are the players involved? There's and kind of the conditions that are in place around it. We're going to have volatility, we're going to have uncertainty, we're going to have risks. But I think the probability of that is the final analysis. And the other thing is, your voices matter. Your voices matter. And just as a reminder, when we went up to the Hill and the secretary and the chairman pushed to get the legislation, do you know what happened that night? It failed.
That was the worst.
It failed. And it got put back on the floor after citizens engaged with their congressmen and Congress lead persons and said, enough's enough. And this is kind of the privilege we have as citizens to vote and engage. And our voice is real. And part of the challenge that we have in the environment that we have is that we have in some ways given that up in social media and everything else. You hear kind of the vitriol and the divisiveness that goes on. But ultimately, I have great faith in the American people, and I think if there were issues that were truly leading to constitutional crisis, and it gets talked about because people want to talk about it, but I think that the American people would step up and feel like, you know what, this is part of the American history, this is part of American culture, this is part of American values, and we're going to stand up for them. And ultimately, the Congress, the courts, the executive branch, the regulators, the military, they understand that, they appreciate that, especially the military.
I live in Washington. I was a Virginian in the room, and I agree with Tony. I think that there will be stretching. I think that the president wants to stretch. I also think that everyone knows the ways in which everyone believes in the Constitution, and there are people in Washington. There are civil servants in the agencies. There are appointees in the agencies. There are members of Congress. There are members of the executive branch. I think he does, but yeah, yeah. I don't know.
Your next question is online.
Our online audience, do you think this series of events since COVID, such as huge stimulus, inflation, rate hiking cycle, et cetera, has effectively disproved modern monetary theory?
I'm not answering that. Here's what I'll say. Like you run a lot of institutional money. I would say the use of the Fed's balance sheet has been unprecedented. It's taking a much longer time than anyone thought it would take to pull back the Fed's influence. I think that the next chapter that's going to play out in the financial markets right now has unfortunately sidelined the Fed from doing what they were planning to do in order to kind of pull back what they had done during the last 20 years, especially with the pandemic and the global financial crisis before that. I think the problem that we're seeing right now is that with the imposition of the tariffs and the injection of a lot of uncertainty that a global trade war could provide, it's kind of sidelined the Fed. So now the Fed can't do much right now. The Fed has two issues. Number one is they were getting ready to deal with the fact that inflation had abated. Now we have a situation where inflation appears to be very much on the table, but we have the issue that stagflation is more prominent now because you have recessionary tendencies as a result of this. So you have essentially placed the Fed in a position that they just have to wait and see and get a lot of data. And I think that that's not a specific answer to the overall theory, but what it is it has tied the Fed's hands a little bit in terms of how to react, because they need quarters of data to see all this play out. And the uncertainty that it's creating is really tying their hands.
I agree with everything David said. I think the only other thing that I'd add is you have to take a strategic perspective here in terms of kind of where the Fed's balance sheet was before the crisis, what they did throughout the crisis, and it wasn't static. They went through multiple changes, and then they had a plan, and they had this in place. And a big part of it also has to do with what's going on at the Treasury. And the amount of debt, because of the deficit spending and the growth of that debt, and then the financing of the interest payments on that debt, and the projections associated with where the debt is going to put continued real pressure. And this, I think, is a strategic issue for the country. And one of the challenges goes back to the point that's up here with regard to time horizons and incentives. We have a real problem, and when you create this misalignment of incentives and interests, i.e. short-term elections, terms of the policymakers, and some of these strategic fiscal issues with the entitlements, the foreign debt, the U.S. debt, the discretionary debt versus the non-discretionary debt, nobody really wants to tackle the long-term problem, and the longer we keep kicking it down the road, the more expensive it gets. And if we stay in a position where the Fed doesn't have that kind of flexibility, the interest on the debt and the refinancing just makes the problem worse. And ultimately, as we all know and as we've seen, leverage is a two-way sword, and we got to manage that. And our economy is getting more and more levered in that context. I also kind of do like the idea of kind of recognizing that, we have these crises and we learn the lessons, but do we? Even when we had the issues with the banks or the money market funds, it wasn't too long ago, just a few years ago, we had banks, runs on other banks with Silicon Valley or First Republic Bank. It was like deja vu. And like, how does that happen? And so there's a complacency. And so this vigilance and rigor in terms of, in that case, both regulatory oversight and investor oversight in terms of corporate treasurers and balances. So I think that we just can't lose our vigilance. We have to play the roles that we have, whether we're in the private sector or the public sector, to ensure the safety and integrity and the effectiveness of the capital markets. James?
One thing you haven't mentioned is Dodd-Frank, which evolved out of this, or at least was the excuse. This was the excuse for its enactment. But anybody who deals with it knows that the bureaucracy of Dodd-Frank is extremely heavy. Is it worth it to the capital markets, to the banking industry, to industry in general?
Well, David and I worked with both Senator Dodd and Chairman Frank. Look, I think that they went at it and did what they thought was the right thing in terms of regulatory reform following the global financial crisis. David, you spent a lot of time thinking about that and working on that, and also kind of living with some of the implications. And so I'd be curious to get your thoughts.
Yeah, see that?
That's why we have assistant secretaries. Yeah. He knows more about financial institutions.
So this is my view. It's not the public policy view. It's not the Treasury view. I do think Dodd-Frank was an overreach. It created a very, very large compliance burden on the banking institutions and on the securities firms. And there were some targeted things that needed to be responded to for the financial crisis. But sometimes when Congress reacts to things, they can put a lot of activities in one bill, and one bill can create a lot of regulatory oversight. So there was a proliferation of compliance costs, legal costs, regulatory costs associated with Dodd-Frank, and that burden played through the banking system and the advisory firms at large. So if you think about, we had a pretty broad banking crisis in the United States, but the smaller firms and the community banks and the regional banks, their issues were not systemic. They were systemic collectively as a whole, but the individual compliance burden that some of the smaller institutions are seeing as a result of the regulatory response has had the impact of constricting credit in the United States. So I do think the banks needed to be recapitalized. I do think they needed more liquidity. I do think with the larger banks, are in a better place than they are, but I do think the compliance burdens were significantly enhanced. And I think that when the Republicans were reelected, one of the reasons the markets were euphoric and one of the reasons that the banking industry was rather euphoric is because they thought there was going to be more of a deregulatory bent coming out of it. I still think there will be, but I think what's happening right now in the markets is all they're talking about is the tariffs and they're not talking about dereg anymore. But I think that's a long-winded way of saying seemed like a lot to me and the compliance burdens were high. My opinion.
I want to do maybe 30 seconds to 1 minute for each of you. You've gotten a chance to know our audience a little bit. I'm sure you can feel some of the anxiety that's represented in the room about the turmoil that's all happening. Can you give us a closing thought, something that we can hang our hat on the issue of the U.S. and global economy?
I'll let Tony have the final words. It's your show. I still think you should be optimistic about investing in America. I really do. I think we have the deepest capital markets. We have the greatest rule of law. Like Tony said, where else do you want to be relying on, regardless of what we're seeing right now and whether or not you have any confidence? What is the alternative? Like people talk about another currency. What is the alternative to the dollar? Is it the Chinese currency? So I'm very optimistic about America long term. I think that's where you should be. I also think that it is your civic responsibility to make your voices heard. I think one of the reasons that things feel quite bleak is that there is a lack of confidence in constructive challenge. I think we're going to get more constructive challenge going forward, and I think that's going to be better for all of us. But I think you should leave this optimistic about America.
I completely agree. I mean, I just think we have issues and challenges, but we have as a nation continued to confront those issues and challenges and find solutions. And it's hard. And we have very diverse economy. I think we're recognizing all of the different sectors in the economy and the dynamism that's in the economy. And there are threats, but these threats can be addressed. These threats can be hedged. And I think a big part of that, while I joked earlier about correlation and causation, in this case, I do think if you have a really strong capital market, you're going to have a strong economy. And in making sure both sectors, the private sector and the public sector, are contributing to that. But we can't be complacent. We can't let somebody else feel like it's their responsibility. We can't have overreach in regulatory response, and we can't have complacency and some of the fragmentations and some of the root causes that led to whether it was the global financial crisis or kind of the speculation. There's this tremendous focus on return. But there is no free lunch. Even in the Treasury market, where we think the risk-free asset, well, why is there so much talk about defaulting on the U.S. Treasury during a debt crisis ceiling? So is it debt? Is it free? No. So there's always return, but there's risk. And the smaller those incremental pickups are in return, you're probably taking extraordinary, larger incremental risk. And it's really important to understand what are the risks. And they come in a lot of different flavors. But to understand what's the likelihood of a risk event, what's the impact of a risk event. And sometimes, you've read about kind of the black swan, low probability, but big impact. Sometimes it's high frequency risk, but it's not that big a deal. And so understanding that and recognizing that you're operating in this dynamic system is why these jobs and opportunities are so interesting, because you never solve the problem. And I think this is why it's important to get people who can be effective in the private sector. But David and I will both tell you, as CEOs of companies, as hard as it is to compete and be successful in the private sector, being successful as a policymaker in the government is 5 times harder. There were times when we were trying to advance a policy agenda and we find out somebody's fighting us. I say, who's fighting us? They said, the White House. I'm like, the White House? We were in the same jersey. And then we found like, okay, we solved that problem, then we got somebody on the Hill, okay? And if it's not somebody on the Hill, it's at the independent regulator. And on top of all of that, guess what? The window shades are up, the press sees everything, and everybody's got an agenda. They have different time horizons. So they're really interesting, but we need to make sure we have good people. And David said something else, so I just want to underscore, because I think people have a misunderstanding of this, and I did before I went to Washington. The people that work, David and I were both nominated by the president and confirmed by the United States Senate. And we're politicals in that context. But the people that work in these institutions as career government employees, they're some of the finest people that you'd ever meet, and the dedication and the commitment. And when we went through, and David highlighted this, and I know you had a talk earlier this year about presidential transitions, I cannot tell you how important those people were during the transition. They have the institutional memory. And when you're dealing with a crisis, and as we got ready for the presidential transition, President Bush grabbed Secretary Gates and Secretary Paulson out of the Roosevelt room into the Oval Office after a committee meeting and said, I'm holding you both accountable. I've been through a lot of presidential transitions. He saw it with his father and President Reagan, then he went through his own with President Clinton, and then he was getting ready for President Obama. And he said, I want this to be the model in American history. And I've seen the good and the bad, and we can do better than the good. And we have a war going on, the war on terror, and we have this war going on in terms of the global financial crisis. Do not delegate this to your staff. I'm holding you personally accountable and responsible. And Paulson took that responsibility very seriously because we were trying to deal with all of these issues with these financial institutions. And we had to leave. You serve at the pleasure of the president. We got a new president. And yet, we didn't want to drop the ball. And so the best way to do that was to bring in the senior career civil servants and make sure that they could be answering the questions and briefing the incoming political appointees that President Obama had nominated and the Senate had confirmed. So, a long story short, I agree with David, be confident. We have good people. It's really important that we continue to send people to engage in these issues and take on these challenges. But boy, having traveled around the world and worked with a lot of other investors around the world and seen kind of the operating infrastructures in these other countries, we have the best, and we got to make it better.
Some days this job feels stressful. It is a true honor to have you both in the room with us tonight. Ladies and gentlemen, David Nason and Tony Ryan.